Good morning. Welcome to the Ross School of Business. I'm Professor Jeremy Kress. Thank you all for being here today. I have the honor of introducing Acting Comptroller Michael Hsu. I'll give you a little bit about his background and then invite him up here to speak. After his talk, I'll do a little Q&A and then we'll open it up to Q&A from the audience. Okay? So we are thrilled to have Mike Hsu, Acting Comptroller of the Currency here at Ross. Mr. Hsu has served as Acting Comptroller since 2021. As Acting Comptroller, Mr. Hsu is the Administrator of the Federal Banking System and Chief Executive Officer of the Office of the Comptroller of the Currency. The OCC ensures that the federal banking system operates in a safe and sound manner, provides fair access to financial services, treats customers fairly, and complies with applicable laws and regulations. The Comptroller also serves as a Director of the Federal Deposit Insurance Corporation and a member of the Financial Stability Oversight Council. Prior to joining the OCC, Mr. Hsu served as an Associate Director in the Division of Supervision and Regulation at the Federal Reserve Board of Governors. His career has also included stints at the International Monetary Fund, the U.S. Department of the Treasury, and the Securities and Exchange Commission. Mr. Hsu is a graduate of Brown University and holds a Master of Science in Finance from George Washington University and a Juris Doctor degree from New York University School of Law. Please join me in welcoming Acting Comptroller Michael Hsu.
Thanks, Jeremy, for that really kind introduction. And thanks for hosting me here today at the Ross School. It's a real honor and a pleasure to be here. So I'd like to start today's discussion with a question. What should the U.S. banking system look like? Is the system we have today optimal, or should we go back to a system with many more and smaller banks? Or perhaps we should follow other countries and have a banking system served by just a handful of large banks? Typically, this question is asked indirectly. How many banks should there be is the most common formulation, sometimes accompanied by a graph like this, showing the decline from roughly 15,000 banks in the U.S. in 1985 to about 4,500 banks today. At the OCC, I've sometimes used a similar graph showing the decline in the number of OCC chartered institutions while overlaying their total assets, which have grown considerably. In 1984, the OCC supervised nearly 6,500 institutions, which had around $2 trillion in assets. Today, we supervise roughly 1,000 institutions with over $15 trillion in assets. These visuals and data points, while striking, lack context. Without context, without a broader view of what the banking system should look like, it's difficult to determine what levels or trends are good or bad from a policy perspective. Some see the decline in the number of banks as a loss or a hollowing out, while others see it as a natural and inevitable consequence of healthy competition. Some see the rise in total assets as positive, while others see it as a threat to financial stability. These views are not trivial. They influence debates about banking and bank mergers. I believe we can elevate these debates if we consider the context and try to develop a macro view by answering the question, what should the banking system look like, more directly and rigorously. My remarks today will start with a discussion of why we should develop a macro view of the banking system and suggest that evaluating imbalances between the economy and the banking system may provide a useful framework for doing so. I'll then walk through three key attributes of today's U.S. economy: its diversity, its dynamism, and its size, against which the U.S. banking system can be evaluated and potential imbalances identified. And then against that backdrop, I'll describe some actions the OCC is taking to improve transparency and trust in our bank merger process. By law, and as a matter of longstanding practice, regulators like the OCC consider bank merger applications on a case-by-case basis. Currently, there's no framework for assessing whether this case-by-case approach cumulatively leads to a good or bad banking system overall. Commentary regarding the banking system tends to focus on one cohort of banks at a time. For instance, criticizing the dominance and financial stability risks of the largest banks, or questioning why there are thousands of small banks, or assessing the uncertain future of mid-sized and regional banks. Studies analyzing the pros and cons of bank mergers also tend to focus on particular products and services or demographic groups. Some of these are cited to support bank mergers, while others are cited to criticize them. Absent a consensus view, policymakers can be accused of seeing what they want to see, leading to a perception that bank merger policy is fickle. Development of a macro view, thinking holistically about the banking system, can provide discipline to these analyses and studies. Developing a sense of what good looks like regarding the overall structure of the U.S. banking system could allow for more effective and stable bank merger policy. As noted in my opening, the banking structure question typically gets posed as how many banks should the U.S. have, which is much too simplistic. If we're going to adopt a rigorous macro view of the banking system, we need to take a more thoughtful and principled approach. The banking system supports the economy and the businesses, communities, and individuals that comprise it. This point bears re-emphasizing when thinking about the system, what the system should look like. Put simply, we don't exist to serve banks. Banks exist to serve us. Therefore, in order to have a view on what the banking system should look like, we need to be clear about what to measure it against. Economies and banking systems co-evolve. They change together and interact in complex ways. One size does not fit all, however. There's a wide range of relationships and co-evolutionary patterns. Consider two extremes. In one scenario, the banking system is woefully underdeveloped relative to the economy. The demand for banking services greatly exceeds the supply. The economy is not able to grow to its full potential, and bouts of financial instability occur too frequently. Internationally, one might see this in certain developing countries. For instance, in Latin America leading up to the debt crisis of the 1980s. Domestically, U.S. neighborhoods that were redlined might also be said to fit this scenario, such as when the government-sponsored Homeowners Loan Corporation created maps like this in the 30s, starving entire communities of banking services and creating imbalance as a matter of policy. In another scenario, the banking system is much larger than the economy. The oversupply of banking services leads to excessive leverage, risk-taking, and financial instability. We saw examples of this in the lead-up to the 2008 financial crisis. For instance, in 2007, Iceland's banking system was roughly 9 times larger than its GDP, and Switzerland's banking system was over 8 times. Domestically, this was reflected in the rise and fall of subprime mortgages and derivatives. The optimal scenario is between these extremes, where the economy and the banking system are balanced. The history of U.S. banking can be seen through this lens, as vacillating between periods of imbalance and balance. For instance, the instability of the state-centric free banking era before the Civil War was balanced by the establishment of a federal banking system and the OCC in 1863, which enabled the Union to fund the war and support national initiatives, such as building infrastructure and railroads. A similar pattern emerged in the 1920s, after excessive leverage and financial speculation led to the 1929 crash and Great Depression. That was followed by a rebalancing of the banking system through the passage of the 1933 Glass-Steagall Act, which effectively separated commercial and investment banking, and through the creation of federal deposit insurance. The lead up to and aftermath of the 2008 financial crisis followed a similar pattern. An interesting period that has particular salience to bank mergers and today is the 1990s. Before the 90s, banks were restricted from opening branches across state lines. This in part explains why the US had 15,000 banks in 1985, going back to this chart. Branching restrictions in both federally and state laws gradually liberalized, culminating in the 1994 Regal-Neal Act, which broadly legalized interstate banking. Some observers note that much of the consolidation that took place in the 90s and early 2000s was due to this legal change. That period also coincided, though, with profound changes in the economy, including globalization, the rise of multinational corporations, the rapid growth of information technology, and significant corporate consolidation. The economic context is critical to understanding bank consolidation and growth during that period. Today, while there's not been a legal or statutory change like the Regal-Neal Act, there have been similarly profound changes in the economic context. In order to understand whether or not there's balance between the economy and banking system requires a closer look at the economy and its constituent parts, the individuals, communities, and sectors that comprise it, and then looking to the banking system to see where and how it matches up. The US economy is uniquely diverse, dynamic, and large. These attributes distinguish it and the banking system from those of other countries. To understand why the US banking system should not, for instance, look like Canada's or the UK's, which are dominated by a small handful of large banks, it helps to unpack each of these 3 attributes. Let me start with diversity. The US economy is extraordinarily diverse across multiple dimensions. Consider the US business landscape. It's an extremely broad array of enterprises, from one-person sole proprietorships to the largest corporations. This interactive graphic captures some of this diversity through a scatter plot of about 700 industries, each dot, across 14 sectors, each color, by revenue, the size of the dot, and concentration, placement along each axis. While large publicly traded corporations tend to get most of the attention, small businesses comprise a substantial part of the U.S. economy and are highly varied. They employ nearly half of the American workforce and generate over 40% of U.S. GDP. As an aside, they're also disproportionately supported by community banks, a point I'll come to later. The U.S. also has an extremely diverse population. Based on the 2020 census, 58% of the U.S. population is non-Hispanic white, 19% Hispanic, 12% black, and 6% Asian. 4% of the population consider themselves multiracial. 14% of the nation's residents are foreign-born, and over 350 languages are spoken here. By 2044, the U.S. is projected to not have one single majority racial ethnic group, and the population is also geographically dispersed, with 46 million Americans living in the nation's rural counties, 175 million in its suburbs and small metro areas, and 98 million in its urban core counties. American states and municipalities are also incredibly diverse. For instance, there are over 90,000 local governments, including 20,000 municipalities. State government annual budgets range from Delaware's at $5.6 billion to California's at over $300 billion. The U.S. economy also has an extremely diverse not-for-profit sector, which spans healthcare, higher ed, et cetera. In 2022, nonprofits employed 11 million Americans and contributed $1.4 trillion to the economy, exceeding the GDP of Saudi Arabia. In addition to being diverse, the U.S. economy is highly dynamic. The agricultural foundations of the economy during the founding of the nation shifted in the 1800s to factories with the onset of the Industrial Revolution. Later, manufacturing gave way to services and the digital economy. In 1917, the largest companies by sector were steel, oil and gas, mining, food, and telecom. By 1967, that had shifted to oil and gas, tech, telecom, film, and autos. By 2017, it has shifted again to tech, financial services, medical, conglomerates, and telecom. By 2021, the digital economy alone accounted for 10% of US GDP, $1.2 trillion of compensation, and 8 million jobs. In most other countries, such change occurs much more narrowly and more slowly, if at all. Finally, there's the matter of size. The US economy is the largest in the world with a GDP of nearly $27 trillion. As the graphic shows, this dwarfs nearly all other countries. The US equities market tells a similar story. There's about 750 large cap stocks trading on the US exchanges with a total market cap of over $30 trillion, as well as 1,000 mid-cap stocks and 1,400 small-cap stocks. 62 of the 100 largest companies in the world are headquartered in the US, while just 11 are based in China and 5 in France. Aggregate statistics across a wide range of areas, from mortgage lending and consumer credit to employment, payroll, to payments and custody, do the same, reflecting the sheer size of the US economy. When asking ourselves what the banking system should look like, statistics like these can begin to provide a sense of the extraordinary diversity, dynamism, and size of the US economy. The context sheds light on why it's so important to promote a diverse and dynamic US banking system, a proposition that is often asserted but not explained. To answer the question, I believe we should focus on whether the US economy and banking system are in balance, and whether and where material imbalances may exist. While we cannot fully answer that here, the stats I highlighted are just part of a sketch. I think it's possible to pose some preliminary questions to guide future research and debate. For instance, Professor Kress and others have noted the US banking system is highly concentrated. The 8 globally systemic important banks, or GSIBs, otherwise known as Category 1 banks, shown here in light blue, dwarf the next largest banks, Categories 2 through 4, and have total assets rivaling the aggregate assets of the 4,000 plus banks smaller than $100 billion, as shown in this graphic. To the extent that such concentration of the largest banks is a concern, i.e. that section is too big, the right policy question to ask is, how can that concentration be addressed while also supporting and balancing the diversity, dynamism, and size of the U.S. economy? The second part of this question is critical. If we focus only on addressing concentration, one could argue that the largest Category 1 banks should be capped and broken up, or that the Category 2, 3, and 4 banks and smaller banks should be encouraged to grow, including through mergers. Mathematically, both would reduce concentration, shrink that light blue area. But each path would result in a very different looking banking system with different abilities to support the diversity, dynamism, and size of the economy. At the other end of the spectrum, there are over 680 community banks with less than $100 million in assets, 2,700 with assets between $100 million and $1 billion, and 820 with assets between $1 billion and $10 billion. Given the size and diversity of the economy discussed earlier, and the many different communities comprising it, are there too many or too few community banks? At what level of consolidation would there be a clear imbalance and impairment in support for the diversity of small businesses, rural communities, and individuals? These and other critical questions about the composition and shape of the banking system warrant deeper study and analysis. It's my hope that researchers, academics, and astute observers of the banking system engage on these to help policymakers and other stakeholders develop well-informed macro views of the banking system. Macro views notwithstanding, the OCC must consider and decide on all merger applications involving a federally chartered acquirer on a micro, case-by-case basis. As I've noted before, we are committed to working with our interagency peers to update our bank merger analytical frameworks, including collaboration with the DOJ on the competition prong of the Bank Merger Act. That work is all ongoing. In the meantime, the OCC is taking action to improve our bank merger applications processes and transparency in order to promote a diverse and dynamic banking system. First, we believe in the power of data, transparency, and research. We'll be taking steps to promote all three. Later this year, we plan to post data on bank mergers subject to OCC review in a research-friendly, publicly accessible format on occ.gov. The data would be downloadable and include applicant information, asset size, CRA rating, target bank information, and the OCC action on the filing. Along with this, we'll be issuing a report that provides a comprehensive review of the literature related to bank mergers and consolidation and identifies key outstanding questions. Second, we believe in the need for clear guidelines. Today, the OCC will publicly release a Notice of Proposed Rulemaking, or NPR, that eliminates the possibility that merger applications will be deemed approved solely by the passage of time. Under a rule adopted by the OCC in 1996, certain merger applications are deemed approved by the OCC on the 15th day after the close of the comment period unless the OCC takes action to remove the filing from expedited processing. The forthcoming NPR proposes to remove that, reflecting our view that bank mergers are significant corporate transactions that require the OCC to make a decision. Included in the NPR release, the OCC will also propose a policy statement that clearly sets forth the features of applications and indicators that are generally consistent with OCC approval under the Bank Merger Act, as well as the features and indicators that raise supervisory or regulatory concerns and may be inconsistent with OCC approval. The proposed policy statement will also clarify the OCC's decision process for extending the public comment period or holding a public meeting. Merger applications exist along a spectrum. Some have significant deficiencies. Others are straightforward because the acquiring bank is a model of safety and soundness and has earned the trust of the community and its supervisors. The majority lie somewhere in between and require varying degrees of scrutiny and multiple rounds of inquiry. The transparency provided in our proposed policy statement effectively proposes chalk lines, demarcating these three groups. For example, the proposed policy statement notes that applications where the acquiring bank has satisfactory supervisory rating, no open enforcement actions, and no fair lending, CRA, Bank Secrecy Act, or consumer compliance concerns, along with other features, are consistent with timely approval. On the other hand, applications where the acquirer has unsatisfactory supervisory ratings, open or pending BSA enforcement actions, poor CRA ratings, or other supervisory concerns are highly unlikely to receive approval unless and until such concerns are resolved. We expect most applications are likely to fall somewhere between these. We look forward to getting comments on the policy statement including the appropriateness and effectiveness of where these lines are set. Third, we need to develop modes of analysis for banking competition that go beyond retail deposits as a proxy for market power. As Assistant Attorney General Jonathan Cantor has noted, the banking system today is radically different than it was in 1995, and it's appropriate for us to assess whether the factual and economic assumptions underlying the 1995 guidelines are adequate to measure and assess the many different dimensions of competition that exist today. I agree with Mr. Cantor's assessment, and it's imperative we work together to formulate a new framework for assessing competition that reflects the current state of the banking industry. In conclusion, I believe we can improve outcomes for the economy and the communities and individuals that comprise it by developing a macro view of the banking system. Such a view could help ensure that our banking system remains diverse, dynamic, and balanced with the economy, as well as inform bank merger policy and decisions. Deeper research is needed, and the OCC looks forward to working with the academic community on that. In addition, as the OCC continues to work with the Fed, the FDIC, and the DOJ on updating our analytical frameworks related to bank mergers, we are taking steps to improve the transparency and processes by which we, the OCC, consider merger applications. We look forward to receiving comments on our proposals to eliminate automatic expedited approvals and to clarify the features of merger applications and indicators that are consistent with and inconsistent with approval. These proposals will be made publicly available later today. Thanks.
Okay. Well, thank you so much, Acting Comptroller Sue. Thank you for choosing the University of Michigan as your destination to deliver this talk. You've whetted our appetites about the OCC's releases today. Let's start with the NPR about removing the possibility of automatic approval for a merger application based simply on the passage of time. Has this been a problem at the OCC? Can you estimate what percentage of mergers are automatically approved based on the passage of time?
So I don't have that number to share today. And I think what's really important is that the mere fact that that exists is a problem. I see that as a problem. Every merger transaction deserves a decision. It really warrants a look and a decision. And as you'll see today as laid out in the NPR, we lay out why that's the case, and how the adjustment, how eliminating that, how that would work in practice. And I think you'll see that it makes sense, right? We're in a world today where we want to make sure that the mergers work for communities, work for the banking system, and work for competition. And that requires a review. And so I think that that's really the rationale behind it.
So moving on to the policy statement that you're putting out today. Can you tell us what you think that the features are of applications that are worthy of approval versus applications that might not be able to be approved?
So I ran through some of this in my remarks, and some of this is just kind of common sense, but it hasn't been written down. And I think one of the key things we're trying to do here is by writing it out and making it publicly available, we are explaining to the public, say, hey, these features and indicators are consistent with approval. And if you hit them, then that's likely to be consistent with timely approval. And here's some features, and any one of which, an unsatisfactory bank supervisory rating, open enforcement actions that are unresolved, those kinds of things are grounds for, are consistent with disapproval. And we just want to be very transparent about that. So there's no guessing, because one of the issues in the bank merger space is uncertainty. One thing we're trying to do here is trying to reduce some of that uncertainty by kind of laying out these chalk lines for what's clearly consistent with approval and inconsistent with approval.
So when I hear you describe the policy statement, it sounds to me like in the absence of red flags, mergers are generally approvable. Is that the right way to think about it? Or should we expect banks to make a more affirmative case for why they should be allowed to merge?
Yeah, so there's no built-in default presumption. And part of this, I think, is because there's a really wide range of merger applications that come through the door. And we suffer, one thing we're trying to solve for is, for the statisticians in the room, type 1 and type 2 error, right? The type 1 error there's the risk of approving too many mergers, in which case you're approving mergers that shouldn't be approved, right? Bad mergers. And then there's type 2 error, which is the risk of not approving enough mergers, in which case there's going to be some mergers which should be approved, and they're going to be pro-competition, pro-community, et cetera. And so by drawing these chalk lines, we want to minimize that because it just makes clear to the industry, this is the yardstick that we are using, and it should help them to assess whether to even apply or not, and how to apply, and then what they can do to improve their chances. And part of that improving their chances, be a really, really safe and sound bank, right? Clean up all of your issues. Stay on top of everything. Serve your communities well. Again, they seem intuitive, but it hasn't been written down. And I think by writing it down clearly with those criteria, it just provides a lot more clarity, both for banks and for those stakeholders interested in the bank merger process.
So one phrase that I did not hear in your remarks today, but that appears multiple times in the Bank Merger Act, is the convenience and needs of the community to be served. You know,
super important.
Absolutely. And you know, when I, as I've written about these topics, one of my concerns is that too often that convenience and needs analysis boils down to the bank's historical CRA rating and whatever vague promises the bank makes about future lending. How do you think about convenience and needs? What does a bank need to show in order to demonstrate that a merger will benefit the convenience and needs of the community?
So let me be super, super clear. So the convenience and needs prong of the bank merger analysis is super important to the OCC as we think about bank mergers. And it's in a couple different ways. So we have a number of Comptroller handbooks that have laid out some of the general factors. And what we do in the policy statement, there's entire sections which focus on this. And so part of it is, as you noted, Jeremy, having to do with CRA ratings, but it goes deeper than that. Branches. What's the plan with branches? Impacts on employment, impacts on the pricing of products and services to the communities, including low and moderate income. All of these are listed out there because we want to, again, we're trying to be transparent about what we think is important in terms of demonstrating that. And there's a balance between being specific on those things and providing enough room so that we can get all of the intel we need to in order to make a diligence assessment, a robust assessment on that. But I think we strike that right balance in the proposal. We'd love to hear comments on that. I mean, these are exactly the kinds of things where if we can be either more specific or if we're being kind of overly prescriptive, the comment process allows us to make adjustments to that so that we can kind of hit the sweet spot.
So you mentioned branches, you mentioned pricing. What other factors do you look at when you're considering a merger?
From the community perspective.
Yeah, what do you think about in terms of how can I, as acting comptroller, determine or assess whether this proposal will benefit the convenience and needs of the community?
So it really depends a lot on the merger that we're talking about. So there are some mergers, it's hard to convey how wide of a range of mergers they are, and each one is unique in the factors it includes. Some of them are actually quite straightforward because they're smaller, simpler institutions, and the analysis of the convenience and needs of the community are pretty simple to do. Other ones are much more complicated. So it really depends on a case-by-case basis what we tend to focus on. Some of it is pretty intuitive in terms of which factors it aligns with. So some of the larger bank mergers, for instance, financial stability is going to be a concern. We're going to put special attention there. Where there's going to be a lot of branch closures, convenience and needs of those communities is going to be a top focus. No, that also, there's an interplay there also with competition. And so those have to be thought about simultaneously. And so it really depends. There's no one-size-fits-all answer to that.
So I want to ask you about a recent merger, JP Morgan, First Republic. You sit on the FDIC's board. When First Republic failed, the FDIC conducted an auction, and the FDIC was legally obligated to go with the highest bidder in that auction. The highest bidder. There were several bidders, but the highest was JP Morgan, and so the FDIC had to award the bid to JP Morgan. You as comptroller, though, still had to approve JP Morgan's Bank Merger Act application to acquire First Republic. You've taken some heat for that decision from both sides of the political aisle. I wonder if you could say more about how your decision in JP Morgan First Republic comports with, to tie it back to the theme of today's speech, comports with your idea of how the U.S. banking system should look.
Sure. So I think that the heat you refer to is really reflecting concerns about the concentration, which you and other academics have highlighted, which I think is a pretty shared sensibility. But as you pointed out, Jeremy, the FDIC in those situations must abide by the least cost test, which is statutory. It's a requirement. There's no wiggle room there for the FDIC. I think what's interesting is there are some ideas to reform the least cost test, to enable the FDIC in situations like that to make a different decision. I would support that. And we have thought about different ideas there. I think that's probably best for a different speech or a different conversation. But I think that's a really important thing to focus energy and time on, because that's the first most important decision that gets made with regard in situations like that. Now, when the decision comes to us for merger approval, we're going to take into account all the statutory factors. We have to follow the law, including for financial stability. And you'll see that in our proposed framework here, we do note that there's this concept of like a balancing test within the financial stability prong about what are the financial stability impacts of approving or not approving a particular merger. We want to be explicit about that. Again, that feels intuitive, but we just want to be very clear that that's part of the consideration. And in any of these kinds of situations, and I feel I can tell you this because we've worked together.
Nobody else is listening. It's okay.
Well,
it's confidential conversation.
For folks who have been kind of inside of a regulatory agency, having to deal with these things live, like the messiness of a practical decision, you have to weigh all of these things. You have to meet all your statutory obligations, you have to follow all the rules, and then you've got the situation you have to deal with. And in those, I'm always going to follow that. I'm going to follow the statute, follow the law, follow the rules and regs, and financial stability is very, very important. Like that, you can't gamble with financial stability. And so that's all part of the considerations when you're looking at that.
So yeah, I'm heartened to hear you endorse changes to the least cost test.
Absolutely.
That is something that's intriguing to me because there's all sorts of costs that bank mergers can and bank failures can impose on society, not just costs to the deposit insurance fund. I want to pick up on the financial stability analysis, though. I keep coming back to the Federal Reserve's June 2021 approval of Silicon Valley Bank's acquisition of Boston Private Bank and Trust.
You'd have to talk to Vice Chair Barr.
Of course. Next time he's in Ann Arbor, we can discuss it. But I ask this question because would you agree that the OCC's financial stability analysis is similar in process? You look at similar factors as the Fed. And the motivation for this question, of course, is the statement in that 2021 order by the Federal Reserve that SVB would not, quote, pose significant risk to the system in the event of financial distress. Does that suggest, given that less than 2 years later, SVB collapsed and caused financial distress, does that suggest we ought to strengthen the financial stability analysis in bank merger?
Yeah, so I've been super consistent about this since I came in, is that prong needs updating. And I think it's really, really important for that and for other reasons. And part of the updating is they're the attributes which I think are fairly agreed upon because they basically mirror the factors for the GSIB surcharge. So size, substitutability, interconnectedness, cross-border, et cetera. So those aren't controversial. I think those are there. To me, what's really important is resolvability. This is really critical. All large banks, every bank needs to be resolvable, period. It's really important. They need to be able to fail in an orderly way without extraordinary government support. And because of that, what we've done is the system, actually when I came into this position, this was spring of 21, the GSIB, the resolvability regime for GSIBs had been now, by then, fairly, had gone through several rounds and developed. I was part of some of that in my previous role. But for the largest banks that were not GSIBs, the categories 2 through 4 that were on, I was sensing that there was a gap. And I talked about that. I talked about the importance of ensuring that those banks could also fail in a resolvable manner, including having TLAC, right? Including having a long-term debt that could be bailed in to recapitalize a failing bank in that situation. And so I had spoken that, we followed through with that with a number of very specific actions, and then worked with the other agencies on that proposal to basically have a requirement which is currently out. Now, the comment period has closed, but we're currently considering how to finalize it. That's all part of making all large banks resolvable, and that has to be a factor when we think about financial stability prong. If you approve a merger that results in an unresolvable bank, that's not going to work, right? I think all would agree on that, and so that has to be a factor. So that's something we've been thinking about. That's why that rule is so important, amongst others, is to ensure that all large banks, all banks period, are resolvable, because otherwise you get yourself into situations like last year's, which are challenging.
So will that resolvability discussion as part of the financial stability prong, will that feature in the policy statement today?
Yes. Yeah.
I want to shift gears for a moment and ask about capital and the long-term debt proposal that you mentioned. You mentioned that the comment period on all of those rules, along with the GSIB surcharge rule, ended last week. One of your predecessors as Comptroller famously approved a big rewrite to the Community Reinvestment Act just 5 weeks after the close of a comment period. So my question for you is, should we expect final rules in February, or do you think that it might push to March?
So we're carefully working through, as you might imagine, we got lots of comments on all of them. We're carefully working through all of those comments. I think it's very important that we work through those very diligently, and that has to run its course. Like, we're not going to rush that. I do feel urgency to get these rules done, but they have to be done right. And part of getting them done right is we take into account all of those comments, and we work that process with our interagency peers to make sure we have the best rule possible at the end of the process. And sometimes that takes time to get that right, and I'm not going to hazard a guess at how much time. But there's a lot for us to think about on some of those rules, and we want to make sure we're doing the right job on that.
As you are working through the comments and moving toward final rules, are you cognizant of the Congressional Review Act deadlines? Yeah. So that's something that you think about in terms of timing? I mean,
to me, it's a thing that exists for which we have no control over. It is what it is. We're focused on just making sure we get these rules as right as possible, and that's how we're proceeding.
You gave a big speech 2 weeks ago about liquidity and how supervisors monitor liquidity risk, how we ensure that banks have backup sources of liquidity. What sort of feedback have you gotten on that speech?
So far it's been pretty good. So maybe just to recap for folks who don't follow all of my speeches, I forgive you. I think the speed of bank runs has sped up. And I think this one stat really kind of captures it. In 2008, while Covey and WAMU failed, the total amount of their bank runs was between $10 to $20 billion each over 2 weeks, over 1 to 2 weeks. Silicon Valley Bank lost $40 billion in 10 hours. Okay, so just to give a sense of magnitude and speed, and because of that, if a bank has a big pool of liquid assets, it may not be able to convert it into cash fast enough. This is the central problem we have to deal with. Having liquid assets is illusory if you can't make it liquid in the time needed. And so that's kind of the problem statement. And I proposed some ideas on certain targeted regulatory enhancements to improve that. Many of them kind of revolving around the discount window, trying to make the discount window more actionable and operational and destigmatizing it. So far the reaction has been positive in the sense that folks seem to be glad that we are really trying to tackle this now. We, not just the OCC, but the federal banking agencies collectively are trying to tackle this now. And there's a lot of good ideas now. The intent of that speech was really to say, here's my ideas, what other ideas are out there? And I really encourage folks who are steeped in this and have good ideas to speak up, because I think this is a really, really important topic. And the bank runs aren't going to get slower anytime soon. So we really there is some urgency to kind of solving this as best we can.
So I will open the floor to questions in a moment, but one more question before we do that. You are a business school graduate. You have a master's in finance from GW. I think that for a lot of my students at Ross, public service is not necessarily something that they think about as a career option. So what's your pitch for coming to be a supervisor at the OCC out of business school? Can you pitch my students
Yes.
on
Yes.
serving the public in the OCC in particular?
Absolutely. So it's not for the money, okay? So we know that, but the money is enough. It's really, if you're curious and you want to understand how systems work, nothing beats the government. It really doesn't. I've been in government my entire professional career. I started off at the Fed as an attorney, then I went to the SEC, basically as a supervisor after getting the MS in finance, derivatives focused, Treasury, IMF, Fed, OCC. It's too good for me. I'm just not interested in anything that doesn't provide that perspective, because you're not just working on one thing. I think that's one of the beauties in government work, is that you get to see a really wide range. You have to do the job well, you have to understand how the system works. And so there's individual things you have to know really, really well, and you have to be able to zoom in and then zoom out and have those conversations. It's fascinating, and if you're interested in banking, there's no way you can learn more about the banking system than working for a bank regulator, because you learn everything. I think if you go into the private sector, you're going to start off in one place, and you're going to get really good at that thing, but it's hard to just get that broader view. And you're working for the American people, and nothing beats that. You go in every single day, you're like, okay, what can I do to improve America, the country, the communities? It seems like a small thing, but I've known a lot of folks who have either worked in the private sector and expressed interest in coming into government, or were in government, went to the private sector, and really want to come back. Because it's kind of an intangible thing. But again, if you're curious and you like to learn about stuff, like, nothing beats it, and it's one of the best kept secrets out there. I was once working with a group of folks, and a banker had told my boss, like, you're going to lose everybody because they know too much, and we're going to hire all of them. And none of us left, because there were offers, but none of us left because, like, the work was just too good. It was just really, really, really fascinating, really, really, really rewarding. And it's like there's never a dull day. So it's great. I highly encourage it.
Great. With that, I'm happy to open the floor to questions. Angela's got the microphone.
Thank you for your comments. I think this is on. I'm curious, so you're talking a lot about competition within the banking system. Yeah. Well, we have these non-bank financial institutions, sometimes called shadow banks,
yes.
which sounds much more nefarious.
Yes.
But one of the issues is, as we regulate banks, more and more activity moves out of the
yes.
banking system into this other. So I'm curious about whether or not that is part of your assessment of mergers, how you think about this other kind of sector that can kind of move in and out of financial activity.
So we definitely need to take it into account in general. I wear a bunch of different hats. So I've got my OCC hat on, the FDIC director hat. I'm also on the Financial Stability Oversight Council. And so that's an important lens by which to kind of think of this dynamic. I think there's a macro way of thinking about it, and there's a micro way. The macro way is we want a system that is not constantly racing to the bottom, and especially in banking and financial services, because that race to the bottom leads to cutting corners on controls, cutting corners on compliance, cutting corners on all sorts of things, which can lead to vulnerabilities. And as we know, in banking and finance, one weak link can ruin it for everybody. And so it's really important that we maintain that. And as you move from across sectors, not just, like within banking, there's different regulators. You've got, OCC, you've got state chartered, Fed, FDIC. Ensuring we've got uniform, consistent, level playing field, that takes a lot of work. And that's something that we're all pretty committed to. And then you have to go with non-banks. Similarly, the answer is not to race to the bottom. I've seen that too many times where there's a pressure like, oh, if you do too much, it'll just squeeze out. So therefore, you should lower your standards. No. I think the right answer is like, therefore, we should focus on what can we do to raise the standards of those who are outside the banking system, level up. And there's different ways of doing that. There's been a lot of competition from banks from non-bank fintechs. So that's been an area of discussion. And a lot of that activity is eventually sponsored by banks in some way. So that's why we've had some focus on third-party risk management to say it's good in many cases to have a healthy partnership between a fintech and a bank. That can, in some ways, deliver fantastic innovation, products and services for folks. But there are some versions which are it's just an arbitrage and a race to the bottom. And that's not good. And so we've been out trying to make sure that we can distinguish between these, encourage the former and discourage and disincentivize the latter. So that's a constant, there's no magic bullet to that. It just requires constant attention and mindfulness on the part of not just us. And it does require also a lot of coordination. No one agency, we've got lots of agencies in the US, no one agency can solve that. We all have to work together constantly. And that's, I think, it's a feature now that we just have to accept and really lean into.
If you could state your name and your affiliation with the university before your question, please.
Hi, thanks for being here. My name is Frank. I'm with the law school. There are a lot of agencies that can assume jurisdiction over a bank merger and challenge it or make it more complicated for the parties to consummate. And I kind of want to get your thoughts on the interplay between those agencies, because it's not just the financial agencies, it's the competition agencies too. And so I suppose the root of my question really is, do you think that that results in too much enforcement or too little enforcement because of all these different agencies acting on the one deal?
We do have a number of different agencies that are involved in the bank merger space. But I would also say that the guidelines and the analytical frameworks are all fairly aligned. So a lot of it came back to, like in 1995, the DOJ essentially kind of harmonized on the competition prong, how to think about that, and all the federal banking agencies basically aligned with that. If you go prong by prong, they're in the same zip code in terms of kind of how and that's why we're working together now to update them, because we don't want one agency over here and one agency over there. It behooves everyone. It's in everyone's interest to align those to the greatest extent possible. So I think that part helps, in large part, address your question. With regard to the FTC, I think that's a different thing. I have to defer to the lawyers on how that works. I know what we can control and kind of where that coordination is most important. Get your steps into there.
I'm Gabe Rutterberg from the law school. Thanks so much for visiting today. It was super interesting. And I wanted to ask you about sort of how you think about and how you try to measure the social value of changes to the banking system, right? So academics, especially I think banking academics, with their love of worrying about things, are very concerned with the problems that come from financial instability, which have had a huge cost within our memory. But your presentation really also captured the enormous dynamism of the U.S. economy, and I was just wondering how you think about whether changes to the banking system are increasing the efficiency, the innovativeness, the quality of service, broadly construed the social value of the services banks are providing. And, as a sort of subset of that question, and I hope this doesn't narrow it, whether you have any sympathy for the research by Tomas Philippon or other people who have expressed skepticism about whether the quality of intermediation in our financial services have increased, at least proportionate to the increase in their proportion of GDP.
Yeah. So it's an excellent question. And part of what my hope today is to really spark exactly those questions, to get more research in that particular space. So I think there's a couple of different ways of thinking about it. So, one, I'll call it a very kind of theoretical view would be, well, this is what markets are for, right? Let the market decide as to whether or not these things are being properly met. And to the extent there are market distortions, that's the role of government to kind of right-size those, for instance, with CRA or things like that. So that's the kind of the 101 version. I think reality is much, much messier. And I can think of examples, like real concrete examples where you take a bank that was a well-run, a good bank that merges with another one, and the bank that it acquires has problems, has issues, is not doing what it needs to either for its community or for financial stability, and that merger is good on all fronts. We can see it. We can see the benefits for competition, for communities, for financial stability. We have those examples. And we've got other examples where that's not the case. And so, I think part of the policy challenge is how clearly can we identify these things ex ante and incentivize the right outcomes. And that's on a case-by-case basis. The really hard question is, overall, how do we know whether we're on the right track or not? And I think a lot of it is kind of a gut feel. I think people's point of references matter a lot in this regard. So I've heard when people have asked me, don't we have too many banks? I'm like, well, what's your point of reference? And if the point of reference is Canada, that's not a good point of reference because we got a $27 trillion economy. They've got a $2 trillion economy. So we're just talking apples and hot dogs. And so we really need to figure out what the point of reference is. And I think it's the dynamism and the diversity of the economy. But then we have to operationalize that. And that we need help. That we need help with. And I think having differing academic views is fantastic. I really do think that's a very healthy place to have those debates because that'll help us. I mean, that'll help us think through, is this delivering what we wanted to deliver rather than just kind of leaving it to particular theories. Like it'd be good if we could empirically get at that with a bit more rigor.
We have time for probably one more question.
Yep.
Hi, I'm Ari Schwader. I'm from the economics group here at Ross. And you started the talk talking about trying to make sure the banking system was, I can't remember the word used, but scaled to the size of the economy, balanced. A lot of the banks that you put up there in that list of the big, the banks are big global institutions.
Mm-hmm. Correct.
And so that got me thinking about when we're talking about scaling the size of the economy, well, there's the U.S. economy, which is big, but it's only 25%. And, JP Morgan Chase and HSBC and whoever serve global. So
Correct.
I'm wondering, as a U.S. regulator, which you are, how do you think about balancing the U.S. view versus some sort of international view?
So I will make it even more complicated for you because a lot of those U.S. clients are also global. So if you've got large U.S. companies that basically operate globally, what's the right way to think about that sizing, that balance? And I think I'm posing it as a question, actually. And I think there's lots of different ways to measure it. But I think that's important. If I could go back. Right, so you get this particular table, and then you go to this one. Where are the largest banks today? Kind of globally, they're actually in China. Right, if you just kind of rank ordered by asset size, they're in China, and you think, well, but China's economy is not as dynamic and it's not as diverse as ours. So, and it's a little bit more contained. Ours is a more global economy, both the companies and the banks that support it. So I think there's some intuition around that, and then that makes you think, well, does that mean the largest U.S. banks? How should we think about them now relative to that? So, I'm just advocating for basically taking multiple points of reference to try to answer this question because I think, on the one hand, we would say, well, a $3 trillion to $2.5 trillion bank is just too big, but relative to what? Like, what is it trying to serve? And what I really worry about is that a lot of the attention tends to be on the top line. Biggest banks, biggest companies. We've got lots and lots of economic activity just below that people aren't talking about. And is that being adequately served? Because I don't think we want, as a policy matter, the mega banks to do everything for everybody. That's actually, they don't want to do that. So how do we think about that? And that's why when I was listing out the equity, 750 of the large cap, $30 trillion, it's the next stat that's most important, actually. 1,000 mid cap, 1,400 small cap, who's serving them? And then you get to small businesses, who's serving them? Like that, I think requires a lot more research and our attention. And that's where the shape, the overall sense of this could either improve. I think there's room for improvement there in terms of how we think about that and what we're aiming towards. Because right now there should just be fewer. And that's not a helpful construct. I think we should be a little bit more sophisticated than that.
So what are next steps in this analysis? You put out the NPRs today.
Yep.
You'll get comments back. What is the OCC staff working on with respect to the topics that you've raised today?
So in many ways, I'm thinking about this. We're approaching this kind of at multiple levels. So what we're putting out today in the NPR is there's a procedural set of proposals, and then there's some transparency. I noted we're going to add to that transparency with data set. And I think you guys will appreciate this because I'm going to save a lot of TAs some work. Because if Professor Kress said, I want to know for every OCC merger, when the application was in, how big they were, all these different attributes, someone would have to go and probably develop some code to scrape it off of lots and lots and lots of different websites.
He's sitting right there.
Yes. So if you just wait, we'll put that out in a clean data set format for you, right? Just one click, CSV file, you get everything. With the purpose of promoting research on that. That's very, very rich. Then we start asking these questions with a lot more rigor to say, was this good or bad for the community? Okay, all the data's there. Now you can just start looking up, just add columns and then do your regressions. Great. So that's really important. And we want to make sure we get that right. And then beyond that, across Fed, FDIC, DOJ, we are constantly been kind of this ongoing work on updating these analytical frameworks. Competition prong, convenience and needs prong, like what are those newer analytical frameworks going to look like? And that's continuing work, and that's something that it's something we've been working on for some time now. But if that's something, I think conversations like this really do help us because it's feedback. It's intel, it's feedback on the direction that we can take that would be productive.
Acting Comptroller Sue, we are so delighted to have hosted you here today. I have it on good authority that you grew up in Columbus, Ohio.
I did. Don't hold it against me.
I'm not sure if you've heard, but we have a pretty successful football team here in Ann Arbor. As a small token of our thanks for you coming to visit us today, we wanted to send you home with some University of Michigan
Some swag.
national championship swag. This is for you to take home and hang proudly in the acting comptroller's office. If for some reason you do not want to hang it in your office, I believe you have a chief counsel
Yes.
who is a triple Wolverine and would gladly hang it in his office.
Yes.
So please join me in thanking acting comptroller Mike Sue.
Thanks, Dr. That's great.